Good afternoon, everyone, and welcome to this Grant Thornton's fifth webinar in as many weeks. My name is Raja, and I'm a partner in the Restructuring and Insolvency Department of the firm. I will introduce today's topic. I will also be your moderator for this event. If you have any questions on today's topic as we go along, please send your queries by way of the chat button. We will address some of your questions at the end. In line with today's topic, we have assembled a panel of experts from our firm, from our restructuring and corporate finance teams. Allow me to introduce them very quickly. First, we have my very experienced partners in the restructuring and insolvency field, Paresh and Martin, who each have more than 16 years experience helping companies through troubled times. We also have our corporate finance team, partners George and Ganesh, and Director Rahul. They are a team experienced in bringing liquidity to deals as well as existing businesses throughout the life cycle of companies. This, as you will appreciate, is even more crucial in times like these. The current slide will help you put faces to their names. Together, the team will take you through today's webinar, and at the end, they will take questions that you may have, time permitting. The agenda is quite simple. We will look at what we in business are currently facing, a quick look at what measures are in place for the commercial resilience of companies during this period, and the temporary legal protection measures that have been put in place. Then we will discuss Grant Thornton's Resilience Wheel for helping businesses through this period and the solutions available. Over the last few months, we have all heard the words unprecedented, challenging, uncertain, global disaster. Well, it is all of these and probably more. The Panel crisis of 1985, the Gulf War of the early 90s, the 1997 Asian financial crisis, 2008 financial crisis, and now the pandemic. You know, I'm probably dating myself when I tell you that I was there during each of those times. But Singapore and the world recovered each time, and we will again together. Obviously, this time, though, solutions have to be more holistic. Before this pandemic, we had experienced a sustained period of growth. And in fact, governments were quite optimistic about the near and middle term. In this crisis, the role of management is twofold. First, to keep afloat, and second, to assess longer-term prospects and survival. This will require continual monitoring, assessment, and tweaking as we go along. This could well be a start, stop, tweak, restart process. New technology adoption will be key to survival. For every organization, it will be important to identify key people who have experienced such situations before. We must form teams that are agile, keep fixed overheads as low as possible, and survive until there is stability and a new normal. We need to think about what post-crisis will look like for each of us, and if required, seek outside help. There are several issues that businesses must look at depending on the nature of the business you're in and the industry you are in. Some of the more important ones are employee welfare, cash flow management, going concern issues, supply chain disruption, fixed cost management, and stakeholder management. Now, our panel will touch on all of these. Our government has passed temporary changes to the corporate insolvency law to protect businesses and directors during this period. This protection is in place for an initial period of 6 months, but it can be extended for a further 6. These changes make it more difficult for companies to be wound up, and directors are protected for insolvent trading. The measures to protect companies from being wound up are twofold. First, debts owed must be at least 100,000 Singapore dollars. And second, there is a 6-month wait period before a statutory demand for winding up expires. What we must realize, though, is that these provisions do not extinguish existing debt, and all other contractual obligations will remain after this. The issues are just postponed to give companies and directors a breathing space during this crisis. Now, while you are protected for insolvent trading, there is no relief for fraudulent trading. The difference is this. Insolvent trading happens when you incur debts while your companies are insolvent, and the debts incurred may not be able to be paid when they become due for payment. Now, this normally happens when businesses are in cash flow trouble, but directors try to work their way out in good faith. Now, fraudulent trading, on the other hand, happens when directors incur debts with the intent to defraud creditors. While there are penalties provided under the law for both situations, those for insolvent trading are currently suspended. There are solutions around these issues for protecting directors. If you have questions on this, we will be happy to address them either at the end of this webinar or even after. So these temporary measures give businesses breathing space to take a good look at themselves and what the future would look like for them. It's important to take this opportunity to make ourselves more resilient and future-proof. We now know that depending on how the infection tails off, our economy will open up in 3 phases. Phase 1 has already started on 2nd June. Hopefully, dining out will be possible soon, even with social distancing and with restriction to group numbers. For myself, I'm itching to get back into the gym for some long overdue exercise. Now, the latest Fortitude budget recently announced in Parliament extends support for businesses to retain jobs, for rental relief, for financing for startups, and incentives for hiring local workers. Taken together, the Unity, Resilience, Solidarity, and Fortitude budgets are all about supporting companies through managing their cash flows, either directly or indirectly through income tax deferment and property tax rebates, wage credits, financing scheme for SMEs, and even bridging loans. Now, clearly, governments around the world recognize how important fiscal stimulus and cash flow issues are to the eventual recovery of economies and the saving of jobs. Which brings us very neatly to the Grant Thornton resilience wheel that I mentioned earlier. I now hand you over to Paresh to explain that wheel in some greater detail. Paresh?
Thanks, Raja, and thanks again to everyone in attendance. I'm really hoping that all are adjusting and transitioning to the new normal. Just to quickly reintroduce myself, I'm Paresh and I'm in the restructuring team here at GT Singapore. I'd like to go over some thoughts we here at GT have had in respect of developing a framework to tackling crisis times. As Raja has alluded to, it's looking all too certain that a deep recession will soon follow, which is also in line with the expected contraction in the economy. And with this in mind, and as can be seen here on screen, we've developed a resilience wheel, which considers 5 areas and which is really designed to support management to develop an approach to tackling and leading through the crisis times and becoming more resilient. The framework isn't a solution in its own right, it's just meant to be used as a guide to start thinking of some of the wider issues at play. Specific solutions in crisis times will be covered off by my colleagues Martin and Ganesh later on. It's also important to keep in mind that the framework is not just for COVID times, but really can be applied to any time of crisis. And as can be seen here on the screen, the plan considers focused attention to the following key areas. Cash management, which is essentially at the core of the framework. Next is contingency planning, followed by the area of stakeholder management. Next, we'd also encourage management to relook at their people agenda. And finally, there is the setting up of a specific and dedicated crisis management team. I'll briefly go over the 5 areas in the next few slides, but just a couple of overarching points before doing so. Firstly, it's really important to understand our experience as restructuring advisors, that one of the key challenges that management faces during crisis times is that attention inevitably turns to focusing on the daily firefight. This plan is really designed to assist in also keeping focus as to the big picture. And secondly, the plan is quite generic in nature. It'll need to be developed for each type of business and industry, and sometimes a further deep dive into the business can be considered to identify further areas to look at. This can be done by the business themselves or by external and experienced crisis management or restructuring consultants who will all be able to bring fresh and independent perspectives. Moving on to the first component of cash management. We've all heard phrases before that cash is the lifeblood of the business and cash is king, and probably now more so than ever. These phrases are true for businesses, whatever their stage of maturity and economic conditions, but this really comes to the fore in crisis times. For example, and somewhat quite obvious, in respect of debtors, management should start to make an increased focus in reviewing individual debtors to bring in cash quickly. This may involve a soft approach, such as negotiations, all the way through to a more harder approach, such as getting lawyers and other agents involved. Additionally, in respect of creditors, thought should be turned as to the holding of discretionary and non-core spend, and when necessary, negotiating with creditors as to deferred payments, all with the objective of easing cash flow. However, and most fundamentally, there may need to be a shift in the approach to cash flow forecasting. All too often in our experience, clients do not have a forecast, or if they do, it's normally a medium to a long-term one. In a crisis situation, we'd recommend a weekly cash flow model covering around 13 weeks. And this approach ensures visibility over quarterly expected receipts in and payments out. In certain circumstances, and depending on the complexity of the business, we may also recommend a daily forecasting exercise, but this in turn will create a bit more work for management. A weekly or shorter term cash flow would really help to identify the critical levers for the business, such as, and amongst the others, identification of covenant breaches and cash shortfalls, what the critical vulnerabilities are that the business faces, and what assumptions have been made which affect cash forecasting exercise, and whether these assumptions are robust and accurate enough. Really, without a solid cash plan and a change to the forecasting mentality, there would be too much uncertainty for the business through the crisis times. Again, we would normally recommend external restructuring specialists to help here, who can really dedicate efforts to reviewing the forecasting process and challenge the underlying assumptions, which will only serve to help clear the fog. The next area that I'd like to talk about is that of contingency planning. Contingency plan really helps to identify actions that a business can take in a worst case scenario, which really helps to be proactive in terms of a plan B. Listed on this slide are some of the examples in respect of developing a contingency plan, such as supply chain. Now, what happens, for example, if a critical supplier has its own financial problems and has entered into liquidation? Does the business have an alternative source? Or should the business consider stockpiling? This situation may become all too real, given these COVID times hasn't discriminated on any one particular type of business, but has really affected all. Another example is that of employees. Now, I think we're all quite used to working from home by now, but whereas so far, we've had to react to the speed at which the lockdown measures were put in place. Now, what happens if this continues to drag on for a really unexpected amount of time? Have businesses really thought about the long-term view for employees? For example, do they have the necessary equipment and solutions to motivate them and gear them up for the longer term? Contingency planning will also include some level of stress testing, which can feed into the cash flow forecasting exercise. For example, if a supplier reduces its payment terms, what would be the impact on cash and the overall business? Moving on to the next slide, which discusses stakeholder management. Now, I don't intend to spend any great length of time here, as the quote on screen says it all. Build a realistic plan and communicate it early to key stakeholders. Referring to the previous slides, there needs to be a solid and realistic plan, but most importantly is to communicate it early to the relevant internal and external stakeholders. Internally, good stakeholder management will serve to motivate and give the right message and keep people on the same page and singing the same tune. And externally, this serves to create confidence and trust. Again, in our experience as restructuring advisors, stakeholder trust is crucial to survival. As an example, without this, it would be all too easy for a lender to come to the decision to pull the plug on a business. The next slide here discusses the people agenda with communication, considering options, and setting policies. This is especially important as people are likely to be your most invaluable asset, and some of the questions in developing a people subplan in crisis times will be the need for full-time versus casual employees, whether flexible working arrangements can be adopted, the need for two-way realistic communication, and business continuity planning, which I'm sure we're all used to by now. Importantly, it's essential to get the plan right in respect to people, because they'll be your biggest brand ambassador now more than ever, with social media such as Facebook and LinkedIn. So it's critical to have the right policies and messaging in place during the crisis times. The last slide that I'll cover off here really brings together the previous slides and pointers. In a crisis, it's crucial to set up a dedicated crisis management team who can really focus and spend time looking at the issues. To re-emphasize, it's all too common, and understandably so, for management to focus on the daily critical firefight, thereby taking time away from dealing with the business and crisis as a whole. The team can comprise of management and also, if applicable, senior spare resource who may not be so busy during these COVID times. However, the team should have representation from all the key departments, and this is really to ensure that all facets are covered and voices are heard. The team can focus on the previous areas, such as executing a change to the cash flow forecasting mentality and stakeholder management, but ultimately they'll have oversight to deliver the business forward with an overall idea to, one, firstly stabilize the business, and then move the business successfully forward through the new normal. I think this now brings the 5 points in the resilience wheel framework to an end. And I think that in conclusion, it should be noted that the points that I've set out here are quite generic, and each business will have specific or unique factors to look at, and a further deep dive should be considered. Ideally, would suggest the use of external restructuring advisors, really to assist given experience in crisis stabilization and business resuscitation, and an ability to bring fresh perspectives from outside of the business. Lastly, would be more than happy to have individual conversations with you in respect of addressing any specific business challenges you may have. And in a nutshell, this is really about balancing being both proactive and reactive to the crisis issues. This brings the 5 points in the resilience framework to an end, and I'd now like to hand over to our partners Martin and Ganesh to talk about some more specific solutions and experiences which we have seen. Thanks, Martin.
Thanks, Paresh, and thank you again for joining us today. I'm Martin, one of the restructuring and insolvency partners here at GT Singapore. As Raja had mentioned earlier, the COVID-19 has quickly brought about an economic crisis, and its impacts are far more serious than past crises. In recent news, some 3,000 AR companies had closed down in April, and an uptick in business cessation is expected in the coming months. We have also seen an increase in restructuring and company closure inquiries in industries such as F&B and construction. The reality is that the temporary support measures from the government stimulus packages can only help that much and are likely not enough to support all businesses through this crisis. If companies are not able to react and look beyond the support period, they may have no choice but to take the exit route. In the next few slides, I will discuss on some of the potential impacts and possible restructuring options to help companies. This is an illustration of how the adverse impacts of the crisis could potentially increase the risk of financial distress over the next few months if a company does not have a robust plan. Sales and revenues have declined significantly over the last few months with temporary closures. Although government subsidies may buy some time, operating fixed costs continue to take a toll on cash flow and working capital, as revenues may be far from returning to pre-crisis. With depleting reserves, companies may have limited choice but to look at capital calls or new financing to sustain the business. However, as debts and liabilities are snowballed, companies may be facing difficulties to repay them as and when they fall due after the temporary insolvency relief has run its course. By then, the risk of financial distress or even insolvency will become imminent if the company did not take action early enough. I'll now touch on some of the early warning signs of distress to look out for within your company or in customers. Falling EBITDA, poor liquidity or credit ratios, and short-term debt maturity are key signs that there are inadequate cash flows to sustain the business. Other indicators such as repeated delays of payments and deadlines, shutting down or delays in reopening of outlets or operations may also be signs of inabilities to perform contractual obligations. If companies start to identify any of these early indicators in their business, they should quickly consider restructuring options such as a debt restructuring or scheme arrangement. If signs of distress are showing in your customers, you should quickly communicate with them to work out alternatives such as repayment plans before their position deteriorates. The key takeaway here is to address pressure points as early as possible and not leave things till it's too late. I will now go through some of the possible options and how companies may react when pressure points start to surface. Companies are likely facing liquidity crunch and underperformance in the current situation. As they restart operations after the circuit breaker, there may be further challenges such as shortage or higher costs of manpower and raw materials, and disruptions in supply chain. This period may be critical may be a critical make or break for companies depending on how quickly they can stop further erosion of values. The immediate focus is to manage liquidity and communicate early with stakeholders to gain their trust, as well as time to assess options. Managing immediate liquidity through cost cut measures or right sizing of business units will allow resources to be focused on its core business and current obligations. Next, the ability to raise new capital through debt and equity will allow companies to have a sustainable capital structure to pursue growth or to rebuild the business when the economy recovers. However, if the companies are not able to stay on top of their cash flows and continue bleeding cash with no new source of funding, the future of their business may end up being largely determined by creditors. At this stage, there may be two possible outcomes. If it is a viable business with a potential for rebound, a restructuring or judicial management may be considered to rescue the company. However, if things are left till it's too late, where statutory demands of creditors are kicking in, companies may have no choice but to then go down the liquidation route. In this slide, we'll look at some of these restructuring options. Broadly, these options can be either through an out-of-court process or a court-monitored process. Turnarounds, accelerated disposals, or right-sizing are out-of-court options to improve liquidity and its capital structure. Recent examples can be seen from SIA raising 15 billion through issuance of new shares, or even AirAsia's reduction of workforce and potential stake sale. I will now elaborate further on debt restructuring, scheme arrangements, and judicial managements, as well as provide some examples from our past cases. The main focus of these three options is to restructure and clean up the company's overall debt position so as to provide creditors with a better realization than in a liquidation, as well as to allow the company to continue operating on a going concern. Firstly, debt restructuring can either be through an out-of-court consensual restructuring among certain group of creditors, or through a court-monitored Section 210 or 211 scheme arrangement. In an example, we had advised and assisted a listed construction company in engaging its group of lenders to work out a plan to restructure the bank debts. A consensual agreement was reached between the lenders to term out their existing loans and obtain new credit lines so the company could continue with their business. We continue as monitoring accountants to monitor the company's performance so as to provide confidence to lenders for their continued support. In another example, we had advised a listed civil engineering company during its restructuring. Operating losses and debts accumulated in the non-core dormitory business has impacted their ability to continue their core engineering business. We assisted the company to quickly engage with stakeholders such as lenders, creditors, as well as authorities to obtain their support for the restructuring through a court scheme. A critical sale of dormitory was completed to stop the cash flow bleed. A white knight was secured to provide the working capital to continue its projects, and creditors' debts were restructured and repayments were through the company's continued operations. So with the necessary steps taken early enough, the company was able to continue operating as going concern during the restructuring period and further clean up its debt position and resume trading after the scheme was completed. The next option is a judicial management, which is a court-monitored process. The key common feature of a scheme and a JM is the formal moratorium, which provides court protection against any enforcement or proceedings. This is critical, especially when a company is facing threats of statutory demands or winding up applications by creditors. A difference is that in a scheme, it is a debtor in possession restructuring where management is still in control of the company and the restructuring process. While in a JM, a judicial manager is appointed by the court to take over control of the company. In a further example, my partner Raja was appointed as one of the judicial managers of a pharmaceutical packaging company. The business had a niche with certain technology patents and limited market competition. However, its cash flow and supply chain had not been managed well, and the company was faced with multiple statutory demands from creditors, and time was running out before a creditor applied for winding up. As such, the company had to quickly make a JM application to obtain the court protection, and as JMs, we continued the operations, sold the business to a white knight, and restructured the company's debt through a 210 scheme as part of the JM process. I will now move on to the last slide that I will cover. This slide is an illustration of the restructuring options and their key considerations, which we discussed earlier, over the various stages of stress, distress, and insolvency. As the risk of financial distress increases, management's influence and control over the business will be lost and taken over by creditors. I would further touch on the recent changes to the Singapore restructuring framework, which could help companies. In 2017, amendments to the Companies Act introduced new tools to help distressed companies and enhance the scheme and JM process. Some of the new changes which can help companies facing crisis are a 30-day automatic moratorium upon an application of Section 211B scheme, a rescue financing that can provide working capital to companies during restructuring period, crampdowns on dissenting classes of creditors, pre-packaged scheme which will fast-track the pre-scheme negotiations and shorten the scheme timeline, the introduction of ancestral model of law to facilitate the recognition of cross-border insolvency process in Singapore. We also understand that a combined insolvency and bankruptcy act, namely the IRDA, will likely be introduced sometime later this year. This IRDA, together with amendments already made, are part of an ongoing effort of the Singapore government to build the restructuring and insolvency framework to help companies. This will be very timely, especially during this crisis period. This brings an end to my points, and before I hand over the discussion, I would like to just summarize. Early distress signs do not mean that the business is doomed. With proper advice and taking necessary steps and options as early as possible, company can ensure that they have every chance to set it right. With this, I will now call upon my partner, Ganesh from the corporate finance team, who will talk about how he can assist during the restructuring process, as well as some of the corporate finance options across these 3 stages. Thanks, Ganesh.
Thank you, Martin, and thank you all for attending this webinar. I'm Ganesh Sabaratnam, partner in the corporate finance division. The corporate finance team, George, myself, and Rahul have over 75 years of experience in investment banking, private equity, advising corporates across Asia Pacific in a number of sectors, from real estate, aviation, telecom, media, technology, infrastructure, healthcare, manufacturing, food, consumer. We have worked on a number of transactions varying across many different products, as well as solutions to clients during challenging times. The services we provide range from capital raising, private placement of debt and equity, M&A cross-border, or as well as domestic mergers, capital and debt restructuring and refinancing. The other forms of financing available as well, mezzanine, convertible debt, as well as management and leverage buyouts available for certain types of solutions. Strategic joint ventures, platform build, private equity, and special situations and distress opportunities. The team has worked through several crises and lived through several crises. The heights of the Asian financial crisis, 97-98, SARS epidemic, dot-com bust, the global financial crisis recently, and now we're going through the COVID-19 pandemic. Leveraging off the experience of the team, we believe we can provide solutions to yourselves during this challenging time. I will now talk about what are the potential solutions available during these challenging COVID times and how we go about addressing it depending on the curve where a corporate sits, which Martin touched on, and the various stages that they're going through. So this graph depicts the risk of financial distress that corporates undergo, and it tends to increase as you go further down. In this case, you're going up the curve, where the influence of stakeholder diminishes inversely as the financial stress increases. In such a situation, as the extreme right, you would see the creditors take over and management and board have a lesser say. corporate finance solutions tend to work well in the informal restructuring phase. Once you go to the formal restructuring phase, it becomes a bit more challenging, and corporate insolvency is pretty much recovery stage. So what are the solutions available in these challenging times? Liability management. This is one of the key areas that a corporate should look for in terms of terming out their cash flow and making sure there's no cash flow debt walls or cash flow stresses, which Martin and Paresh talked about. And how do you do this? This is to look at your debt maturity profile and ensure that it's pushed out as far as possible, and it's evenly spread out such that your cash flow can pay back your debts as they come due. And in such situations, we tend to advise corporates who are able to go and tap the capital markets through the bond market or the private placement market, or in some cases, the loan markets where such facilities are available. You'd probably want to refinance existing maturities which is coming out in a year or two to push it out to 3 to 5 years. What this gives you is time to restructure your business in the new norm post-COVID as we emerge. As Raja mentioned, we could be in a situation where there could be a second wave or third wave. So how do you reposition yourself if such a situation happens? And currently, we've seen the credit markets come back from its lows in March, where it almost resembles during the global financial crisis, where credit was tight. Companies, in order to go, the other form of solution that companies will look at is forbearance. In order to qualify for forbearance, creditors, banks, bondholders will look for companies who can demonstrate that under pre-COVID-19, there was no underperformance. They were performing as planned. And during COVID, they were affected due to revenue loss and the stresses in the current market. And in this situation of forbearance, creditors and investors and the credit investors are willing to forbear up to 6 months of interest, but amortization are deferred to a much later period. And financial covenants can be deferred for a period of, say, a year, depending on the lenders and the credit of that company. The lenders would then need to review the business plan and the financial model that the current company has presented. And this can be done by the company, or you may want to seek a financial advisor where we can help you do that. So the business would need to go through the assumptions in making the financial model, get independent industry experts to verify that particular assumptions that drives the financial model. The other alternative available for corporates these days in certain sectors is government or agency money. What we encourage is for corporates to maximize as far as possible what can be gotten by this aid or period of stress. However, getting government money can be long and slow. In certain countries, it responded much quicker than the others. For example, in the US, where the sectors that are widely affected are the airlines, aviation sector, tourism, hospitality, and travel industry. The US government has responded pretty quickly. They were one of the first under the cash support scheme with the 202 trillion financial stimuli, which helped airlines. They allocated billions to airlines to bridge this gap. But under this scheme, airlines were not supposed to lay off staff or restructure the business. So such support comes with certain conditions which can tie the business up. The other recent example is Cathay Pacific. Just recently, a couple of days ago, announced a $5 billion injection, $3.5 billion of which is from the Hong Kong government through a rights issue as well as short-term liquidity support, and $1.5 billion from the existing shareholders. And SIA had the recent $8.8 billion rights and mandatory convertible bond issue, plus an additional $9 billion, and all of that being backstopped by Temasek. So in such situations where in these countries, the governments are willing to support and they have deep pockets to support certain industries, clearly it makes sense for corporates to go for it. However, a lot of these package comes with preconditions. So in terms of employment, what the company can do, how can they move forward, their hands would be tied somewhat. But obviously it's probably a cheaper form of financing. But bearing in mind, in some cases, these money are long-term money and some are short-term bridge. But once this bridge matures, the companies would think about what are the alternatives. So outside government and agency money, there are debt refinancings possible for certain stretched companies. Typically, these companies will have to go to the existing lenders to refi their current position with potentially capital market solutions. Currently, the credit markets have improved dramatically from the depths of February and March. Investment grade and certain high yield companies can issue bonds. The high yield bond spreads have tightened since February, where high yield index were trading at about 1,100 basis points, and now they've come into about 700 basis points. So, and investment grade has tightened significantly. So we encourage companies to explore these public markets first. And if it's not available, the other alternative they can look is private markets. There are a number of credit funds out there that are willing to support companies which are in the mid-range, in a few $billion market cap, or in the large mid-cap size companies or large small cap companies. And there are various structured solutions available where companies can look at securitized financing based off their receivables, asset-backed financing, shareholder financing, getting support from their sponsors. The third form of financing going down the capital structure will be equity. Here, private equity have raised tremendous amount of money in 2019. They have in the region of $1.5 trillion of undeployed capital or dry powder. So coming into this crisis in 2020, the private equity is well positioned to help certain companies and sponsors of groups to ride out the situation and move them forward. Besides these various forms of financing across the capital structure, from senior secured all the way down to equity, companies can explore non-core asset sales. Pre-COVID, a lot of companies expanded looking at new business opportunities. So some of these business opportunities at this point in time may not be their core focus, and they should look to divest this. So divesting non-core assets and going back to their core business is a strategy that's well served many companies through the past crises. In the Asian financial crisis, you've seen a lot of conglomerates expand from Indonesia, Malaysia, Thailand, to many different sectors, multiple industries. But post-crisis, they all started divesting their non-core assets. Similarly, in the GFC as well, banks who had investments in insurance, brokerage, all divested those post-GFC. The other alternative is to look at strategic JVs and tie-ups. with partners with stronger balance sheets or wider market share, where the combined operations could weather this COVID storm, as well as take you post-COVID and reposition you in a much stronger position. The final option could be consolidation, and we are going to be seeing more consolidation happening down the road and in the next few years as this the solution to COVID is being addressed. Here, generally, the larger companies would tend to, with robust balance sheets, will tend to consolidate the industry, resulting in fewer players. Unless the smaller players rationalize and become more nimble, remodel their business quickly using technology and improve productivity to drive growth. Those smaller companies who are more nimble would come out much stronger in this phase. So it seems like there's going to be two spectrums, the very strong getting stronger and larger, and the small nimble ones who come out of it and look to grow their business and their footprint post-COVID. So that's under the informal restructuring, where the company is undergoing stress or underperformance. As you move up the curve, you can see where the risk starts increasing and the influence of management and board of directors as well as shareholders diminishes and creditors' influence increase. Here, the options, the corporate finance options decreases. Here, a company would be looking at rescue financing, tapping out private equity, special situations, distress funds, and where a company would approach potentially a white knight or a strategic partner to come up with a package during the scheme of arrangement, which Martin talked about under section 210 and 211. So the moratorium gives you breathing time, but ultimately the corporate has to come up with a more viable business model that can take him through this COVID and come out stronger. And that's what the investors are looking for. A lot of private equity like buying companies somewhere between the informal and formal, preferably more informal basis. Because once you go to the formal basis, the creditors become very defensive, and it gets harder to actually perform transactions and tap liquidity in the capital markets as well as private markets. Because what happens is during when a moratorium is triggered, it triggers cross defaults, and creditors and a number of creditors and stakeholders get affected, and they tend to run shy when a company enters this situation. The other alternatives a company can do is continue their non-core asset sales, and in some cases sell some of their core businesses, which unfortunately they may have to do in order to go back to their primary core business to weather this storm. The last phase is corporate insolvency, where what happens here is the solutions corporate finance can offer is far fewer than what we discussed during informal and formal. Here is essentially a recovery phase where the creditors are looking to maximize the monies they can raise by selling off all these assets, or in some cases, potentially subsidiaries that still have value. Here, the potential investors are distressed funds that are looking at potential opportunities of certain assets, and mostly hard assets, real estate, or it could be aircrafts, it could be certain assets that have value in the market and can be liquidated, and there's a recovery available. Subsidiaries which are in this situation typically are, unless they are not affected by the holding company, they tend to be in a similar boat. The final solution could be an RTO where the listed shell has value, but the core business of the company has been affected. And here, typically, private companies are looking for a fast route to listing, would reverse their business into this shell. However, SGX does not look very kindly to this recently, and they've made it challenging for RTOs. So the timing to do an RTO is similar to an IPO. So to summarize the various options available, I will, in the last slide, go through the key considerations for corporate. The speed is of the essence in responding to this pandemic. How quickly a company can survive and turn around and obtain liquidity is the key driver. Thankfully, during this crisis, there has been a V-shaped recovery in the capital markets, financial markets. Equity markets have rallied back to its pre-COVID levels. The S&P 500 is almost near its record high, past 3,200. NASDAQ has gone past 10,000, it's an all-time high. The other markets, the Kospi index in Korea has retraced 50%. And we are seeing a lot of corporates tap these markets for equity. So those who can, we encourage them to do so. However, there's a big variance between financial markets and Main Street. Main Street GDP and economic recovery still seems like a U shape or potentially a W shape. But the financial markets are saying that we are looking through this, we will get through this. It may take a longer time, but in a couple of years, we hopefully should overcome this. So while this going is good, we encourage corporates to look at various options to raise liquidity. The cost of capital will certainly may be higher than what companies were used to pre-COVID. However, they've come down significantly since the heights where credit spreads were much wider and the cost of equity was much higher. Now it's admittedly higher than pre-COVID, but we encourage corporates to tap these markets whilst they're good. The credit funds, the fixed income funds, all would be looking out for value transactions. So paying up a bit more to get long-term financing makes a lot of sense now. And the private markets, there's a number of private credit funds out there, family offices willing to fund businesses in this current market. Some sectors may encounter permanent structural changes during COVID and post-COVID. These sectors would be aviation, hospitality, retail, and even real estate. We'll be going through a new normal. Unlikely we'll go back to the old normal. So is your business positioned for the new normal and for potential headwinds? The good thing is Ben Bernanke, the previous Fed governor, said this is much closer to a major snowstorm than the Great Depression. Ben Bernanke was a student of the Great Depression. So on that brighter note, I'll pause and I'll hand it over to Raja.
Thank you, Ganesh. I'd like to thank the panel for their contribution so far, but I'm not done yet, and I'm not going to release them just yet, as I have received some questions which they may have to address from the audience. I think we have time for maybe one or two questions, so let me get to the questions quickly. The first question I have is, I think I'll put to Ganesh, and basically you've got a couple of minutes, Ganesh, to answer this question. The question is, can you please provide examples of how capital, you talked about capital and the cost of it currently. One of the questions that I received is, can you please provide examples of how capital is more expensive now, given all the fiscal stimulus and all the stuff that governments are pumping into economies?
Sure. In the public markets, high-yield bond spreads at elevated levels, they are ranging in the bond index is about around this 6% to 7% region, and that was as of end of May. In the private markets, the mezzanine debt or structured debt is in the range of a high single digit to mid-teens. Private equity hurdles are in the 20% IRR range. So that's to give you a flavor of what the cost of capital structure. Clearly, the higher up your capital structure, the cheaper it is. Senior secured and senior funding from your relationship banks would be higher than what you were used to. Example, if you're used to a LIBOR plus 100 basis point, it'll probably go up 20-30% from there. So that's what we are seeing now.
Okay, thank you. One last question, and this I'm going to put to Martin. I received a question from the audience. They are asking, I know you gave some examples, Martin, earlier, but let's talk more currently. One of the questions is, are you helping someone right now, and what is that like, this current job that you're doing? If you could share without names, of course.
Sure. Okay, we are currently helping a few companies, right, who are at various stages of distress. So maybe I'll use the most recent example. We have just been appointed as the independent financial advisor for restructuring of a construction company last Friday. So the company had just filed a Section 211B scheme application, and they are in the first phase of the 1-month moratorium. So as part of the day one of restructuring, we will focus on the 3 areas, as Paresh had also mentioned earlier. So firstly, looking at reviewing the company's 13-week cash flow to identify the funding gaps, critical payments, so that they can continue operations of the company. 2 is then to carry out a liquidation scenario analysis of the company's financial position to ascertain basically the worst case scenario of a return to creditors. And then concurrently, we are working with the management to communicate with stakeholders, the creditors, to basically get their support for the continuation of the scheme process and the extension of the moratorium. So by the 3rd week of the 1-month moratorium period, we will be submitting an update report to the court on our analysis, as well as on the views whether the company and its creditors are in a better position than in liquidation, as well as an overall framework of the scheme that's going to go forward. And then the court will then decide, considering our report as well as the views of the creditors, and to decide whether the company can continue with this scheme process and then allow an extension of the moratorium.
Right. Well, I think so. The trick is make sure that the numbers are right and the debt of the company can be managed going forward, and get the creditors' support in order to either term out the dues or reduce the debt in some way, I guess. Yeah.
Correct. Yes.
Okay. Really, what we have discussed today are things that we all really know and understand, I think. However, during a crisis, we may not have the time or expertise to successfully navigate the potential pitfalls, especially if you are firefighting operational issues. So planning and taking action early is key, and getting outside help could also be crucial. Any other questions that we're not handled today, we will get back to each of you or after this webinar. And of course, if you have questions, even after this webinar, you can send them to us via email or to our GT website. With that, I would like to thank everybody for being on my panel, as well as the audience for being here today and sharing with us on this webinar. Thank you very much. Be safe.